Yes, we can. You are good to go.
Oh, okay. All right. Well, first of all, and Rich, can you do that spotlight thing, whatever you were talking about, so I can see Travis up there?
Yeah, I made you one.
He got buried, and it's hard enough talking to a screen. I gotta tell you, I really appreciate being able to see everybody's face, because how Rich and I got connected here is through Andy Teasley. And so I just thought all of you guys in the club look like Andy. And so I'm glad to see that that's not the case. Andy spoke at our meeting a little over a month ago, and we've known each other for a while. So anyway, want to say thank you guys. And Rich, thank you for the opportunity for us to join you. I am coming to you from Denver, a little south of Denver, kind of between Denver and Colorado Springs. And Travis is deep in the Midwest somewhere in a hotel room. And so anyway, we're gonna go ahead and get started. Is that possible to do that?
I did pin both of you.
Did. For some reason
when you share screen, it shrinks you down, and you can't go back to full screen. It's
all right.
So real quick, what you can do is on your top right where it says view, you can move it to side-by-side speaker. So that's a view on yours, Brad.
Hold on. On the view, excuse me.
Yeah, it changes your toolbar when you share screen.
Okay. Give me just a second here. Okay.
Usually it's on the top, kind of top right. It'll say view.
Okay. I've got participants, stop video, pause chat. I'm not seeing that, but
I'm seeing Brad. I'm seeing on far right-hand side of my screen, far right up top, all the way to the end. You're not seeing it on yours?
No, I am not.
Yeah, it changes the interface.
Okay, I got you up there now. I can't see everybody else, but I can see you, Travis. So we will we'll get started here. Okay, sorry about that, guys. I apologize for the technical difficulties there. Hey, when Travis and I first started putting this presentation together, I came across this quote that I thought was quite applicable from Will Rogers: always drink upstream from the herd. Those of you who have been around as long as we have, you kind of know what I'm talking about when we look back to say around what, Travis, 2008-ish, something like that.
Yep, that sounds about right.
Yeah, but anyway, because this is the first time we've spoken and just met a few of you, I'm going to turn it over to Travis. And Travis, why don't you go ahead and introduce yourself, and then I'll go here in a second.
Yeah, will do. I think the cool thing was, I like, Rich, how you did that, where you did the breakout sessions, because I think I've met almost everybody that's on tonight. So that was kind of neat to get to chat with everybody a little bit. So just to give you my background, been investing, my company's called Invest One Properties, been doing that for about 13 plus years. And it's kind of interesting the way I got into it. My background was in mortgage banking. And so I had a mortgage bank, and back in maybe 2006, we started to get a lot of people call us. And you guys will appreciate this with today's scenario. You know, rates were low for back then. We'll put it that way. Maybe 7 or 8% back in 06, 07. And so what happened was, we'd have people calling us, say, hey, I want to refinance, pull some cash out, pay off all my credit cards, you know, all that kind of thing. We'd say, great, let's do it. And then what we started noticing is, like we're seeing a lot these days, a lot of people would come back 6 months later, say, hey, let's do that again. Let's rinse and repeat just on the refinance side. Well, that worked until it didn't, right? All of a sudden what happened is appraisers started calling us saying, hey, Travis, I know you think this house is worth $300,000, but it hasn't gone up in the last 6 months. So we would have to tell our clients, hey, we can't refinance you. And all of a sudden our clients started freaking out, saying, what are you talking about? This is how I supplement my income and my lifestyle. I need that money to do that. So pretty quickly, you know, since we were really boots on the ground at that point, we realized, wow, we're going to have some issues here. Now, again, I wasn't sharp enough to do the big short thing or anything like that, or anticipate the depths of the recession in 2008, but we did see an opportunity. And I thought, hey, it's funny. I remember thinking to myself, wow, maybe home prices will go down 10% or maybe even 12%, and there'll be a good buying opportunity. So I started putting some stuff together with other folks and started learning about it, prepping up to do it. And at that point, what happened is, that's when I met Brad. Brad was running a real estate investment club in Colorado at the time called IRR. And I said, hey, Brad, would you mind mentoring me with investing? I think, I want to do flips. I know there's lots of money to be made out there. Home prices are going down. So I think I can buy houses affordably. And we met. And in the first 5 minutes, what happened was Brad burst my bubble. He said, hey, Travis, I'll help you and I will mentor you. And it's quite clear to me you don't even know what you don't know, which he said that in a very, very nice way. But he basically said, where we're at in the cycle right now for real estate with home prices going down and, unbeknownst to us, going to crash basically in the next 6 or 8 months, he goes, you don't want to be flipping. You want to be looking at maybe buying, holding, something like that. I'm happy to mentor you on that and not on the flipping, which thank goodness he did, because I would have lost my shirt had I tried to flip back then. So long story short, Brad mentored me for a little while. And I said, all right, great. I was off and running, started doing a lot of properties in Colorado, grew it over the years. And here we are 13 years later. We've done lots and lots of properties. Almost exclusively, we just focus on buy and holds. That's my background. And now we just continue to grow it.
So Travis, that was 13 years ago?
I think so. Yeah, 2008.
Yeah. Yep. And so Travis disappears. And then comes back and calls me a few years ago and goes, hey, I've got this idea, I'd like to talk to you. And I'm like, so what have you been doing? And he rattles off pretty much what he just rattled off. I'm like, did you not think to call, write, maybe let me in on any of this stuff, But no, it's all good. Those were the days. And there's so many things that we're looking in the rearview mirror now going, gosh, I wish I woulda, coulda, shoulda. But anyway, my name's Brad Padowski. And as Travis told you, I've been involved in a lot of different things. I've mentored folks. I've done a lot of wholesale deals, flipped, buy and hold. We're going to talk about smaller turnkey properties tonight. And worked with a lot of students. There was a time in my life where I got really tied into just working with students. And I got kind of away from my first love, and that was doing deals. So I still do a little bit of mentoring, but primarily what we're doing is we're doing deals. So what we're going to talk about tonight is what we do, right? And what we do is, and we're the first to admit over the years that we made a lot of mistakes, but we've also gotten a lot of experience. So what we're going to talk about tonight is that experience, and our hope is to be able to impart some of that, what we would consider wisdom, on you. And another version of this presentation is called Rentals to Retirement. And although we're not necessarily talking about retirement tonight, but we are talking about retirement, because to me, retirement, and by the way, it is okay to go ahead and chuckle at that picture. Every time I look at it, it makes me smile. But retirement to me is being able to do what you want to do when you want to do it. So by that definition, Travis and I are retired because we're doing this with you tonight because we want to. That being said, and I run it. Oh, one of the things that, and how we got connected is I run a group very much like this called Investors Realty Resource that Travis referred to here in Denver. And I've been doing it for about 20 years or so. And so we, in our group, kind of similar, we're always trying to help each other. But what I always tell the folks that I'm working with is if you're going to attend a presentation, I don't care if it's a meeting like this, or you go to some ballroom somewhere or whatever, you kind of want to go, all right, what is their agenda? What are they up to? All right. And so we're going to tell you right up front. First of all, anything that Travis and I do, all of our money goes to needy children. Our needy children, he just had 2 of them graduate from the University of Colorado and has got the last one going out. And I got two headed for college here in the next couple of years. So no, I'm not kidding. This is part of our business. And what we are going to share with you tonight is just, again, how we do our business, give you some ideas of maybe a little different way of thinking, and hopefully open your mind to maybe a little different way of investing. And what I always tell people is, I don't care what meeting you go to, you're probably always going to pull something out of it. Our hope is that you'll pull quite a bit. And this is what we're going to cover this evening. Really creating passive income. To me, you can't quote unquote retire unless you've created that passive income. And we're going to talk about that. We talked a little bit about it in our breakout, that cash flow versus appreciation, and how to analyze a market, what type of properties to look for. That is a very personal thing. We're going to kind of tell you what we do and how we do it. And hopefully we'll give you some ideas to come up with the right strategies for you and how to fund them, and also how to get started. So Travis, did I miss anything at all?
I think we're good.
Okay. All right. So I'm going to turn it over to you and let you just kind of talk about that retirement plan, if you will.
Yeah, thanks, Brad. So one thing we usually do is we kind of set it up. I know a fair amount of you that we spoke to in the breakout rooms, pretty experienced real estate investors. There's also some people that are first-time folks. So basically what we try to do is set it up and say, hey, is this a retirement plan? What are you doing with your investments? Are you investing in stocks, real estate, that sort of thing? And what we like to do is do a comparison, and we're going to take this through the entire webinar. We're going to show you how we do this by the end. But let's say you've got $160,000 that you can invest for retirement. Okay. And we get people that have that, maybe that much in their self-directed 401k, maybe in their IRA, something like that. And they'll say, hey, I'm going to invest that in the stock market. Go ahead and roll that, Brad, if you would.
Sorry. Yep. There we go.
And let's say you invest that at 9% per year for the next, excuse me, for the next 6 years or so. That 160,000 would grow to 245,000. Now, a lot of people, when they're looking at, hey, what's that going to do for my retirement? Well, those of you that have invested in the stock market or are getting a little bit closer to retirement have probably said, hey, what can I conservatively withdraw each year and not dip into my principal so I don't run out of money? Most people these days are saying 4%, give or take, maybe 5, maybe 3, but 4 is usually what I hear more and more. Okay, well, if you do that, then based on the 245,000, that means after 6 years, you've invested that 160,000. You now can pull about 9,800, call it $10,000 a year. You can draw that for retirement. What we're going to walk you through by the end of the webinar tonight is how you can take that same amount of money, invest it in real estate very conservatively, and rather than being able to withdraw and make 10,000 a year, we can get you pretty close to 40,000 a year.
And by the way, as far as this presentation goes, we've kind of condensed it down. If there's something that comes up that you really are not understanding, so you don't forget, either write it down or go ahead and send it in the chat. I don't always get the chat notifications, so we'll probably end up going over them at the end. But we want to make sure that we're covering any questions that might come up for you guys. Okay.
So basically, like we were just saying as a review, we're going to show you by the end how you can take that same 160,000 that's going to generate you $9,800 per year if you invest in the stock market, and show you how doing real estate, as many of you know, we can juice that up substantially, where you're maybe making as much as 4 times the money each year. So, again, huge difference there. $816 a month. I'm not saying that that's bad money, but I think we all would agree, if we're looking to retire 10 years, 20 years, 30 years down the road, or hit that level of financial freedom, it makes a lot more sense to at least put some money in investing in real estate to go along with the stock market.
Okay. So go ahead, Travis. I'll let you.
Yeah. So having said that, and you can just pop these all on there, Brad, if you would. reasons to invest in real estate. Again, all you guys are here. This is a real estate investment club. I'm not going to spend a ton of time on this. I just want to point out a couple of the bullet points here that I think are key. You maybe have read this. They said last week, it's a 5 million home shortage right now. That's the conservative number that I've read nationwide. They're expecting that to hit 10 million unless the builders can ramp up like crazy, which they're very hesitant to do for a host of reasons. Lots of new household formation. The millennials are forming new households like crazy, probably especially now that they've been in quarantine, living with their parents for the last year. They're probably about to go crazy. Because of that, we're seeing some of the lowest vacancy rates in the last 20 years. We're seeing lots and lots of rent upside for the next 5+ years. Another key thing that we see all the time while you want to think about it, and again, I know most of you already are thinking this way anyway, but 87% of all new homes, which includes also multifamily that have been built in the last 4 years, has been A-class, or let's call it luxury housing. So no one's focusing on good quality, let's call it working class, B quality rental stock. But these are all reasons why we think real estate makes a ton of sense. Now let's compare it to the stock market. You can do stock market, you can invest as well. But if you look over the last 18 years, even with the run up where I think today stock market was pushing all-time high again today. And it's been, off and on close to there for the last, 6 months. And it's run up ever since March of 2009. You're still, after fees, the average net annual returns about 3.75% over the last 18 years. And I have a lot of people that come to me and say, hey, I read in the Wall Street Journal, stocks were up, 45% since the pullback last February or last March. Why is that? Why am I not seeing more money? Well, here's why. If you look at it, basically, we talk to people all the time and we say, hey, the key are the declines. The nice thing about real estate, maybe it's the get rich slow concept where we all would say, hey, 10% appreciation is huge. Where in stocks, they're like, oh my gosh, 1 year I made 17, next year I lost 14, whatever. The key to this chart, which shows you, if you go down the middle column there, the S&P 500, these are major declines since 1970. And, just to hone in a little bit, look at that bottom line I've highlighted in red. Between February 19th of 2020 and March 23rd, the stock market was down 34%. I think that was in like 22 trading days, down 34%. And people say, I don't understand, if the market's up 50-some% since then, why I'm just back at square one. And we always tell them, hey, look, you got to remember, let's say you had $100,000 in the market. If the market pulled back 34%, now you only have $66,000 working for you. So a lot of people intuitively think, hey, I lost 34%. I should be able to make 34% and get back to square one, but it doesn't work that way because you have so much less money in your nest egg. You'd actually have to make 52%. Throw in there the crazy amounts of volatility. And I have a lot of people come to me and say, hey, Travis, here's the problem we're having. We're almost exclusively invested in the stock market and we can't sleep at night. We can't deal with the volatility. We think we want to peel off a little bit of that money and maybe invest in long-term buy and hold investments. And that's what Brad and I are going to be talking about the rest of the webinar tonight.
Yeah. And we are, we're somewhat preaching to the choir right now. I realize, because you guys are not here at a stock investment club. You're here at a real estate investment club. But I think it's really important to get that background down, and also it's important to really take a look in the rearview mirror to see, what have we learned over the last few years. And go ahead. I think this is a great article, Travis.
Well, yeah, you get a kick out of this. So we've obviously been doing this a long time. I don't know if you can actually see the faded date on this Barron's article, but it's July 26th of 2010. And it says Renter Nation, housing bust, tougher mortgage standards. We're going to see Renter Nation for the next 5 years. And we get a kick out of it because then Brad rolled to the next one. I found this just, a few months ago, I guess. And same thing, U.S. will become a renter nation. I guess this guy was too young to read the initial, broadcast in Barron's, but it came out October of 2020. So almost exactly 10 years later, wow, U.S. is still a renter nation. And now with a 5 to 10 million home shortage, I think it's safe to say, and I'm sure Matt would confirm this, that I think it's going to be renter nation for the foreseeable future, which, hey, as landlords and investors or potential investors, this bodes well for all of us.
Agreed. So if we're looking to, to invest for the long term. Now, when we say long term, we're not talking about fixing and flipping. That's a whole different program. I did a thing on that on my group this last week about what is the difference between investing and what is investing and what is not. I would make the very strong argument that wholesaling and fixing and flipping are a very nicely well-paying job, but they are a job. They're not really investing. You're buying something and you're adding some value and you're turning and selling it. Now, but if you're looking for the long term, we look at, there's a micro market that you would look at for those short-term deals, and then there's long-term deals. So what we're going to do is just kind of go through how we evaluate a different market, because we're located in Denver and we do investing in Colorado, but we also do investing in other areas as well. So if that's the case, you really have to take a look at what is that market telling you. And one of the big keys that we look for is net inward migration. Are people moving in or are they moving out? And if they're moving in, what is the reason that they're moving in? Likely it's because of a low unemployment. And we like to see it obviously lower than the national average. Crime, I think, that goes without saying. We want a low or decreasing crime rate. And we're also looking for areas where there's a housing shortage. As Travis just talked about, we like those affordable properties. And one of the key indicators there is if it's new construction. And Travis, I'll turn it over to you now. Let you take rising rents and go down.
Yeah, so we're always looking at things, and some of you already are familiar with this stuff, but we're looking for rising rents. We want areas, statistical markets where we're seeing the rents go up year over year. We're always focused, Brad and I call it the twin pillars of real estate investing. We're focusing on stable, long-term cash flow, along with potential appreciation, strong appreciation. So if you're from California, like most of you are, or Denver, like we are, we have a tough time coming up with the strong long-term cash flow unless you're putting a tremendous amount of money down because prices have run up so much. We're looking for other areas where maybe we can still get that. We want a large, highly educated workforce that's going to drive companies there, keep companies there. We want high rankings in quality of life, per capita job growth. We want to see lots of large corporations, whether it's the regional offices or world headquarters there. And again, we want to see appreciation. We're seeing it 5% plus. I know 5% sounds really low right now, but when we look at this historically, that's what we're looking at, because this is a get rich slow plan, not pie in the sky.
Agreed. And I apologize, guys, if you're seeing that cursor there. Somehow I got that ribbon to go to the top of my screen. And if somebody knows how to tell me to get it to the side of my screen, I would really appreciate it. Actually, I think I just did it. So anyway, go ahead, Travis. I'm sorry.
Yeah. So here, what we have here is I just threw this up. I know a lot of you are all from the Inland Empire, but it still gives you a concept. You've all lived the same thing. You've all seen the run up in prices. So when you look at here, look at this. This is from 1989 to the present. Okay. And hey, I'm as optimistic as anybody. Like I said, Brad and I live in Colorado. We've seen an incredible run up as well. Maybe not as incredible as California, as we saw the pullback, and then we've seen the run up. But what we say is we take a step back and say, hey, if we're going to be fair about this, we have to evaluate and say, hey, maybe there's some more upside still in California. Okay. Perhaps there is, but also doesn't it make sense to perhaps look at other markets where maybe it's going to be a little bit more stable, a little less up and down, but at the same time where we can get that consistent cash flow so that rather than we're only living for the appreciation or the hope of the appreciation, we know we've got that money coming in month after month. So this just gives you an idea what LA looks like. And then we're going to compare this to a couple of other markets that we work in. So here's Denver and Seattle. Again, same thing. We've got some people that I market to in Seattle, as well as San Francisco. Same thing. I mean, their home prices have run up, not unlike You guys in Inland Empire, Denver, Seattle, Austin, we've all seen this over and over.
Yeah, and when Rich and I first started talking about this presentation, I got to thinking, I'm like, you know, there's so many parallels between where you guys are and where we are. It's just, you've lived it more than we have. We're on that trajectory that has just been crazy. Even in the last few months, the prices have gone up. So what we're gonna do is kind of compare that. And so when we say Denver, you can just kind of substitute Inland Empire or whatever, you know, Riverside or wherever your market is there. And what we're talking about here is comparing it against maybe a market that's not going up like we've seen here in Colorado and that you've seen in California. But here's an example of just a really good Midwest market that we happen to be pretty familiar with. If you look back from 1970 to 2020, this is house prices and just what they've done over the years. And yes, there is a rise up, there's a little bit of a dip, but it's a whole lot flatter curve than what you guys have seen and what we've seen. You don't see those peaks in valleys. So if I'm investing for the short term and I'm on that run up, I look like a hero. I can tell you in Colorado, there is a whole lot of people that look a whole lot smarter on paper than they're in real estate than they really are. And so there were a lot of people back in 2005 to 2008-ish. Now, I don't know what the market is going to do, but I do know that it will not remain static. It's going to go up, down, and it's going to go sideways. When that's going to happen and how much, I don't know, but I can look back historically and take a look at what markets do I want to be in for what fits for my investing objectives, right? And that, when I say that's what you need to do. You need to say, what is it that I am trying to accomplish with my real estate investing business? Am I trying to create a high-paying job? Then that's fine. Maybe you do want to do wholesaling and fixing and flipping, but if you're looking for long-term cash flow, you know, depending on where you are in that cycle, over time, I do like real estate over the long run, regardless of the market, but it just depends on what your time frame is, right? If you've got 30 years or 40 years or 50 years, you could be looking at something different than somebody who is, you know, maybe only has got 15 to 20 years before what they're, you know, trying to create that financial freedom or their passive income. So, okay, anything else on that, Travis?
That was plenty. Yeah, let's.
Okay. All right. Okay. So, with that being said, we've been talking about markets. Let's drill it down a little bit more to why do we like the types of properties that we do, and we feel like this is a building in a pyramid. The foundation is always for us is cash flow. And if you are going to lever it, which we love leverage in the right way, you've got amortization, tax benefits, hedge against inflation, and then finally, with the cherry on top is that market appreciation. Now, let me just go into this a little bit more in detail, okay? That cash flow for us is cash flow that I don't have to worry about every single day. It's cash flow that I know is going to come in month after month after month. Now, am I going to have some issues with that cash flow over time? Of course, everything is. But for the most part, I want to create, if I'm trying to get to financial freedom or retirement, whatever you want to call it, I'm trying to create as much of that passive income as possible. And then amortization over time, that if I have a loan on it, that my tenants will eventually pay the mortgage. I think as an investor, you should be sending once a year, send a Christmas present and a thank you card for thanking them for making the mortgage payment for you all year long, right? And then tax benefits, I'm not going to go into it too much, but that 1031 and that depreciation, that phantom loss, and then a hedge against inflation. We are entering into an inflationary period right now. You're seeing a lot of people heading towards those hard assets, and there's a reason for it. That will those assets will rise, and we are seeing that. And then finally, market appreciation. This is not anything that we discount. It's just that we don't build our portfolios on that market appreciation. I've seen too many people get in trouble for that, but it is, for us, it's very important. And so those are the 5 profit centers that we see out of the types of properties. So what we thought we would do is kind of show you some of the properties that we've recently been involved in that we like. And we happen to like single family homes. So Travis, if you want to make any comments on any of these as I go through them.
I love them all. You know me.
Yeah, these are very typical.
So these are traditional. Yeah, these are traditional homes. This is one of Brad's favorites here. Not the greatest looking house, but Brad, tell him why you like it so much.
I like it because there's cash flow here and there's cash flow there. I could care less what the front looks like. It's beautiful to me. Right?
Yeah, no, it's true. And basically what we do is we're looking for properties in value add areas, typically B quality, maybe B minus quality properties. That's a nice 4-plex right there, by the way. So we do small multifamily as well. That one has a nice bungalow there, but these are just all classic properties. They're always going to be in vogue, always going to be easy to sell down the road, always going to be able to make money, cash flow, easy layouts, but and a pretty good variety of properties as well.
Okay. And, we look for that affordable property. So where are we looking? Our little motto is live where you want, invest where it makes sense. I think that's very applicable for folks that live in California as well as in Colorado.
Absolutely.
But we focus on that strong cash flowing Midwestern markets is really what we focus on for cash flow. Okay. For example, Travis, I'll let you take this.
Yeah. So this again, you probably already saw we had the one slide there. So here we're talking about Kansas City, that statistical metropolitan area. But this just gives you some of the metrics on this to give you an idea. And I'll just point out a couple of things. That unemployment number, I don't have a current one post-pandemic, but it has consistently been a little bit below the national average for the last several years. Median age 35. Okay. As a way of reference, the median age in Colorado is 37, and it's trending younger all the time. So is Kansas City. Lots of large corporations there. You can see that. Lots of universities there. So we have that really strong educated workforce. And what we're really trying to do with this is show you how this ticks off a lot of the things that Brad was talking about, things that we look at when we're trying to say, hey, should we invest in this market, particularly when it's out of state and outside of our backyard? Look at some of these other metrics here. 10-year population growth, 7%, going to add another 400,000 people. Average rents increased by 8.6% in 2020. In 2021, I believe they're up 11%. I just haven't updated this slide. The largest employment increase in Kansas City were government jobs. Okay, I'm not going to say that's good, but we know though it's not good for all of us tax-paying citizens, but it's really good when you want stable jobs and you're driving growth in the local economy. That 12-month appreciation, I also didn't update that. If we did a rolling 12-month in Kansas City, they're over 20% now, which probably comes as no surprise to you when the national average was what, 22% they came out with the other day. But these are all the numbers we're looking at. And whether we're talking about this particular city in the Midwest that we use as an example, or other cities you guys are looking at investing in, these are the things you want to be thinking about. And this is something that really hit home for Brad and I. Brad, why don't you tell them about these slides?
Yeah, that appreciation, by the way, I'm just going to mention real quickly, we update that all the time. But when we first started doing this presentation, it wasn't anywhere close to 10%. No. And but the presentation and our feelings were the same. Again, that's icing on the cake, and we love it, but we don't build our business on appreciation. But anyway, there was a time when we did this presentation, it was back in 2017, and I got a call from a realtor friend of mine the next day. She's like, hey, Brad, did you see that article in realtor.com? I'm like, no, I didn't. But she's like, you got to take a look at it. She goes, it's backing up right what you guys were saying. Kindred cities, affordable alternatives to your favorite pricey places, which kind of cracks me up because I'm a Colorado native, that Colorado is now considered a pricey place, but it is. But here's what they detailed. And they had a bunch of different pairs, but Denver versus Colorado City, or Denver versus Kansas City, excuse me. I mean, median home price of 500 grand, that's a whole lot higher now. It's about 600 now versus Kansas City, 245. And yes, that is higher, but it's still not anywhere close. I mean, heck, we're talking about half, right? And so you take a look at the wage difference, the affordability difference in those two types of markets. And so those are the kind of things that we look at, and we're just happen to use that as an example. If we had 4 hours, we'd go through others, but I think, you know, we're cash flow guys. We are build that income, build that reliable, consistent, conservative income.
Well, and let's compare that a little bit, Brad, because that's a great point that you make there. And it's funny, this is a little story that we always tell, where I went to this webinar a little while ago, and this guy gets up there getting everybody pumped up. And probably the average age of all the investors there was 30, 32. A lot of them were new to investing. And he goes, hey, I want to tell you, I own 4 or 5 properties in Denver, and I'm losing $250 to $300 a month on each one of them every month. And I don't care. I don't care at all, because the tenants are paying down my mortgage and I'm buying for appreciation. This is Denver, Colorado. You cannot tell me that prices aren't going to be higher 5 years, 10 years, 20 years from now. You know, don't listen to others. My dad told me not to buy. I'm still buying. That was actually his sales pitch, which I have to be honest now. I was close to the oldest guy in the room. So maybe I'm a little more cynical because I felt the pain a little more than some of the younger people, because we lived through 2008, right? We've all seen these ups and downs. But I listened to the guy and I'm like, you are setting these folks up for failure. If you're not getting both the positive monthly cash flow with the potential for appreciation, we all know how that can end. It ended badly in California in the mid 90s, in 2006, 2008, same with Colorado, same with many places around the nation. But it's interesting to contrast that with how Brad and I approach it. Hey, like he said, we got kids to put through college. We can't afford to take big risks. We have to have that strong positive monthly cash flow. So again, for us, difficult to find properties in Denver. We said, hey, we're going to have to look outside our backyard. So we started doing this many years ago.
Yeah. So, you know, we, right now he looks pretty smart because property has gone up. And I don't disagree with him in the short run, but we are looking, again, our time horizon is quite a bit longer. And that is partly because of our age, but mostly because of our experience. So our experience tells us, again, that we're going to go through some of these dips, and I want to be in a good position when I go through those dips and valleys. That being said, we're going to drill it down into a little bit more practical. The other thing that, you know, we've looked for the market, we've looked for the type of the properties. Now, what do we do with those properties? So go ahead, Travis.
Yeah. So basically, we're not going to spend a lot of time on this, but as you would expect, when we rehab the property, we're turnkey property providers. We're delivering a top of the line rent-ready rehab. Now, in the Midwest, rent-ready does not mean granite countertops. It means exactly what you'd expect. Good, solid, faux granite countertops. We want it to have hardwood floors or some sort of vinyl, avoid carpet at all costs. We want to make these kind of bulletproof so that the tenants are there. And aside from normal wear and tear, these properties are going to hold up over time. So these are all the things that we do. And Brad, if you want to click through the next few slides, it'll give you kind of a before and after. Nothing fancy, but, you know, we jazz it up a little bit, you know, two-tone paint in the interior, carpet if needed, or refinished hardwoods, do a nice kitchen, nice bathrooms, about exactly what you'd expect us to do with the rehab. And if you want more pictures or spend more time on that, let us know afterwards. We can chat about that. But in the interest of time, we'll move on. So we always tell everybody, you know, and those of you that own investment properties, or like Matt, who's managed these, okay, you'll appreciate this. We tell everybody, I don't care how great the property is. I don't care if it's in the best location ever, and it's the best rehab of all times. The number one rule of buy and hold properties is you're going to make or lose money on your property based on how well it's managed. And that's even more important when you're investing out of state. Again, you're going to make or lose money on your property based on how well the property is managed. I can't overemphasize that enough. From the mistakes that I've made personally managing my own properties, Brad, you've got stories. Matt, I'm sure you can tell us stories till the cows come home, as many properties as you're managing, but there's no substitute for good property management, period. And a lot of people say, what do these guys do exactly? You know, what am I paying for? And Matt, I heard you say at the beginning here when you're doing a little intro, maybe it was in one of the breakout groups, you're like, I add value. You're certainly going to get much more than we charge. And man, I'll tell you what, you're never going to get more value than the 10% or whatever your property manager charges. They're out there following up on the house. They're doing all kinds of things. They're screening properties. They're doing in-home visits to make sure that tenants are taking care, however they're taking care of their property now is how your property is going to look in 6 months. You want to make sure you do these little things. Again, we could spend hours on this, but you have to have best-in-class property management. So what we've done is we've partnered up with best-in-class property managers in the cities where we offer properties. So we handle that aspect as well.
Okay. And yeah, I mean, we got some great stories. I got a cat lady story that I'd love to tell, but I just don't have time tonight. Travis would kill me if I did. But what we're going to do now is we're going to kind of get into more specifics with some numbers. And hang on, guys. We're going to try not to lose you in these numbers. But what we want you to do is get a concept here. But this is how we evaluate properties. We're going to compare this is a typical property in Denver. My guess is this is even 390 is probably a little less than what you guys would see out there, unless you're buying one of Andy's wobbly boxes. But for a property, go ahead, Travis. I'll let you detail through this.
Yeah, no, you make a good point, Brad, because I would say this is probably a little bit low for Denver even now, because I haven't updated this slide in probably 6 months, but you in California, you're like, yeah, I wish I could find good, solid 3 or 4 bedroom investment properties for 390 or 400 grand. But just for the sake of an example, we're going to use this Denver property and then we're going to compare it. So let's say the property was 390 grand. Let's say you put down 20%. You're going to take out a traditional loan, right? Conventional loan, 20% down plus some closing costs, comes to about 83, 84 grand, something like that. All right. This one here, it rents at $2,100 a month. And that's the Zillow estimated rent. They say it should rent for $2,045. We're getting a little bit more than that out of it. But again, you put down your 20%, you have to take out a loan for the remainder, and that gives you a loan of $312,000. And I think I did it at 4.25%. So it's pretty close to today's rates. Maybe it's a little bit low. Still gives you a payment of $1,535 with just principal and interest only. And then on top of that, you've got another $479 for taxes, insurance, 8% for property management, vacancy, and maintenance. We tell everybody, make sure you're comparing apples to apples. You've got to budget for all these costs. Again, anyone that's owned properties before will tell you, you can budget for them or not, but you're going to have them. So you might as well budget for them. Yeah. Long story short, you take the rent, $2,100, subtract out the mortgage payment of $1,535, then subtract out your $479 for taxes, insurance, and everything else, leaves you with about $86 a month. And again, I think we were being very kind to come up with positive cash flow when we did this slide. And I'm sure those of you that have investment properties in California, especially if you bought them in the last few years, I don't know if your numbers are this good, because even in Denver, they're not typically this good. But nevertheless, let's say it was $86 positive per month. That's $1,000 per year, gives you a return of about 1.2%, not counting any appreciation.
Okay, so let me stop right there. Okay. Why do you buy that house? I mean, if we were in a live, I would ask you to respond to me, and it's kind of difficult here. But you buy that house, do you buy it for the cash flow? Likely not, right? So you've got other reasons for buying it, and they may be very valid, right? They may be, it's your money. You got to put 83 grand into this thing. So you say, is that the highest and best use for my $83,000? And the answer is maybe. You know, but you're banking on it. But in Colorado, what we are looking at is we're seeing this meteoric rise in values. I mean, this property just a few years ago was not worth anywhere close to that. And so if it continues to do that, you look like a hero. But my thought is, I don't think it's going to continue to do that. Is it going to fall off a cliff? I don't know. But I do know that we've gotten to a point where that cash flow is razor thin, if non-existent at all. So you got to ask yourself, why? Why am I entering into this type of an investment? Okay. And again, those reasons may be very valid. Let's compare that to a little different type of a property. Okay.
Yeah, so you saw that last property. It was a 3-bedroom, 1-bath property in Denver. You know, nothing fancy, had a carport. Here's another property very similar in Kansas City, 3-bedroom, 1-bath. I actually think this is a 4-bedroom, 1-bath, 1-car attached garage, but, you know, very similar properties. Nothing fancy, you know, built in the late 50s, early 60s. But let's say you took that same amount of money, that $83,000 you put down on the Denver property, but rather than doing that, you just paid all cash for this property. And I mean all cash, because a lot of people, they question it, they shake their heads, they say, hey, we don't want war zones. We're not talking war zone. We're talking a B or a B- quality neighborhood that's on its way to becoming a B or a B+ type neighborhood. $80,000 all cash for a rehab property. Closing costs come to $500 total. And that gives you monthly rent. Obviously, it's not $2,100 a month, but it's $900 a month. It's probably a little bit more than that now. Your taxes, insurance, everything else only comes to $295. It's a lot lower. And even though property management's a little bit higher there, it's 10% rather than 8%, but overall, you're not paying nearly as much. What does that net you? Well, you don't have a mortgage payment because you paid all cash. Got to love that. So really, you've got your $900 monthly rent, subtract out the $295, leaves you about $600 a month. $7,200 a year gives you a return of 9.1. So on the previous one in Denver, you're getting 1.2%, not counting appreciation. Here, by using all the exact same amount of money to buy one property, you're getting 9.1%. Now,
yeah, again, it's your 80 grand, right? You have to decide what you're going to do with it. If I want to put it into a property and look for the appreciation, maybe the Denver property works. But if you're looking to generate cash flow and passive investing cash flow, maybe that 80 grand would be better spent on a different type of property that's producing a higher cash flow. So let's take that and take it one step further.
Yeah, absolutely. I mean, I know a lot of you that I spoke with said, hey, we got to make a better return than that. You know, we've got to make more money. And if you saw on our list of things we look for, one of the main reasons we love real estate is the ability to leverage your money. So Brad and I think we've made it quite clear by now, we're pretty conservative real estate investors. All right. We don't take big risks. So let's say we took that same $80,000, but we only put down, with this one, we did all cash, $80,000. On the next slide, it shows us with leverage. Let's say we put down just $40,000. So we're super conservative. We put half down, but let's say we took out a loan for the other half. Let's see what that does to the numbers. All right. So the only difference from the last slide in this one is now we have a mortgage payment. The rent's the exact same, $900 a month, but now we subtract out the mortgage payment of $266 and the $295 for taxes, insurance, and all the other potential costs. Nets us about $340 a month. $4,000 a year. That's about 10.2%. So the other way we were making more money per month, $600. This way we're only making $340, but we only tied up half of our money, and that was being very conservative. So in theory, using the same amount of cash as we did for the one Denver property, we can buy 2 properties here in Kansas City. And there, if you roll to the next slide, Brad, those 2 are going to cash flow somewhere around $680 a month. So using the exact same amount of money, you want to make $678 a month or $86 a month, 600 more a year, over 7,000, or 600 more a month, over 7,000 more a year. That's 10.2%. versus 1.2%. And people ask us this all the time. Come on, there's no way these properties can cash flow like this. And again, we tell people, look, you've got to kind of suspend your disbelief for a little bit. You've got to think outside the box. These properties do exist out there. It is getting more and more challenging to find them, but these numbers are absolutely doable. Brad and I have been doing this for 13 years. The numbers just get better and better. So these are very realistic numbers that we're posting up here.
And the other thing that I would challenge you on as well is going back to this property here. You put 80 grand into that property. And again, this is in Denver. We still invest in Denver, so I'm not ripping on Denver, nor am I. I'm just saying maybe you want to take a look at things a little bit different. But when you have this property, you put that $80,000 into it. Your margin is razor thin. So if somebody goes vacant, right, you've got a what would you say, Travis? $1,500 a month.
Well, with taxes and insurance, $2,000 a month nut you got to cover there.
Yeah, so you got $2,000 a month. So that could wipe out a lot, right? In addition to that, when are you really going to own that property? In 30 years, right? Again, depending on what your time horizon is. That time horizon is completely different than if you were to take out a $40,000 loan. And we're going to go into this a little bit more detail later. But if you're looking at getting into a low leveraged place later in life and a high cash flow, maybe something like this time horizon might work for you, where if you're in your 20s and you got, a 30-year mortgage is not a big deal. Unfortunately, when I was in my 20s, and Travis, I think you were the same way, 30 years just seemed like a long time. It doesn't seem a lot anymore, right? So, okay, go back to,
you just alluded to it. Yeah, let's face it. What happens if for that? Okay, your mortgages are so doggone small. It's only $266 a month, and you got two mortgages. What if you take that extra positive cash flow you had each month because you want to prepare for retirement or financial freedom, and you have your tenants pay off those loans? You can pay off these properties or the mortgages on them in as little as 5 to 6 years. So you can own both properties free and clear in as little as 5 to 6 years. And we haven't mentioned appreciation. So we have lots of people come to us all the time, say, hey, I have $150,000. I have $200,000 I want to put to work. What can we do? We'd like to buy 4 or 5 properties, pay those off in the next 5 or 6 years so that we can retire and replace our income or start to build for retirement.
Okay. So if you take that leverage, you got 2 properties at $340 a month each, 72 months net cash flow, that's net. Plus you throw in that a little bit of appreciation, that comes up to 90 grand with as little as $80,000 down. So that's what that leverage and that cash flow can do for you if you apply it in the right way. Okay. And that way we are not relying on that appreciation for our retirement. And so let's compare it to the stock market. Go ahead, Travis.
Yeah, so you're getting you're netting 14.2% per year if you're doing that over 6 years, every year for the next 6 years. That's what you'd have to make in the stock market to equal that return. I don't know about you. I can't get that. Okay. I'm optimistic. I always think I'm going to do great, but I can't get that consistency. Difficult for me to do it. And again, we're talking 4% appreciation there as well. So, lots of reasons to peel off some of that money and invest it in real estate.
Sure. Okay. So we're just going to go through, kind of compare it. Here's that property, our base property that we're using, because it's a very typical, you guys are not familiar with the areas, but it's Northeast Denver, where a lot of rentals are. And go ahead, Travis.
Yeah, here's just a few more properties that we've done recently, just to give you an idea that the numbers are somewhat consistent across the different properties. Here's a property, an all brick property in St. Louis. Again, look at these sales prices. They're so affordable, although quite honestly, I probably should start updating these slides. I just updated them 3 or 4 months ago, but the prices we're paying for the properties are going up very, very quickly because, you know, it's becoming discovered now. And so people are realizing, hey, this might be the last opportunity I've got over the next 18 months or so to actually build a portfolio of affordable properties. But again, you know, you walk yourself through that one or through Spruce here. Here's one. This is a little more expensive, 90 grand. But again, look at these numbers, $350 a month. And again, look at how Brad and I formulated this. We're not doing 20% down. We're doing these ultra conservatively with 50% down. You can put down less, but the numbers work, the returns are great, and you can pay these off very quickly if you choose to. I think the next one's a duplex. Yeah, here's another duplex we just did in St. Louis a couple of months ago. You know, super strong. And this one here, you know, they put down 60 grand. This is a couple that's starting to build for retirement. They've since bought 4 or 5 more properties from us, but they're making $600 a month positive cash flow from this thing. They put down 60 grand. They've still got money left over compared to buying a property in Denver. So it's a powerful, you know, investing tool to help build your retirement income or, you know, achieve financial freedom.
Yeah. And I would be remiss if I didn't point out to a bunch of people from California, we are not BSing you with these low taxes, insurance, property management numbers. It was a real paradigm shift for me when I started in these markets. I'm like, you got to be kidding me. Insurance is $80 a month or $25 a month or, you know, whatever. And it really is true. You just got to adjust down for those numbers. So I'm going to move into this real quickly on, you know, okay, Brad, Travis, that's great, but how am I gonna buy one of those properties? Okay, obviously, cash. I mean, it's very difficult there's very few people out there that can buy a $400,000 rental for cash, right? Almost everybody leverages them. But when you're talking about these lower numbers, now you're talking about where you can use some of that qualified money in a self-directed IRA, self-directed 401k, you know, something like that that's self-directed. Or maybe somebody that you can partner with that has money sitting there in a self-directed IRA. The one thing that is difficult with those smaller properties is to get traditional financing. So because the loan values are so low, it's just very difficult for banks to loan on those. You know, if you're buying an $80,000 house and, you know, they just don't want to screw with those small numbers. So what we have created in our company is in-house financing. And this is just because something that we do to help, you know, with our clients, but it's possible for you to get, you know, that one-on-one financing as well. If you know somebody that's got a, you know, 80 grand sitting in a 401k and they're not crazy on the stock market, which I think there's a lot of people right now, there's plenty of ways to do this financing. It's just, you got to kind of get out of that traditional box as well. Our in-house financing is very flexible. We'd love to talk to you about it. You know, we don't care about how many properties. We know the properties, you know, and we know the borrowers as well. So we're not, we don't do underwriting as a traditional lender would.
Let me add a couple of things there too, Brad. When we created this financing, what we did is we wanted to make sure it would work with any self-directed IRAs. So it complies with any self-directed IRAs. We will lend directly to the IRAs, to any entities. So it's similar to a hard money loan or an asset-based loan, although the interest rates are not hard money types. But again, we underwrite everything in-house. We close quickly, closing costs super low, no limit on properties. We don't care if you're self-employed. We don't care if you showed a loss. We don't ever need to see tax returns, W-2s, credit reports, anything like that. But we can get into more of it later if you have questions afterwards.
Yeah, and this is something you can do as well. Believe me, you know somebody that's got that kind of money in an account that could be self-directed. Okay, and I don't have time to go into all that tonight, but you know, a lot of our clients that we're working with right now are 1031 clients that in Denver, and I would imagine you guys are the same way, that you've seen a tremendous run up in values, and depending on, again, where you are in that investment life cycle, you may want to be taking your chips off the table. But anyway, just to run through the basics of this, Travis, I'll do this and then I'll turn it over.
Sure.
You know, you sell that property in an expensive market, you take those proceeds and you put them into a 1031. You don't touch those proceeds. You buy a property, or in most cases, the clients that we were working with are buying multiple properties. We got one guy right now that's selling 2 condos. He closes on one tomorrow, and Travis, and the other one, he's buying what, 7 or 8 properties with us?
Yep, 7 or 8 properties and paying no taxes.
No taxes from the original sale. You're delaying it, and then you collect income from multiple properties. So he's leveraging up, preparing for his retirement, and it really is that simple. But here's a good example of what we are seeing, and I'm guessing you guys are probably as well.
Yeah, this is another, and you can roll through all the pull-ups there, Brad. So we had a client, she owned 2 single-family residences in Denver, similar to the client Brad was just telling you about. She had them rented a little bit below market, but they had great market value and she had a lot of equity in these properties. And so she wanted us, she told me she was literally, she was, just keep rolling that, Brad. And she said she was netting $300 per month. She actually said she was only netting about $150 a month, according to her own spreadsheet. And she was worried because what happened is on one of the properties, the furnace went out and she's like, oh my gosh, I'm not even netting enough from a year and a half worth to pay for this. You know, what am I doing? How can I make a little bit more money? And we've had a nice run up in Denver. She bought these properties for on the order of around 90 to 100 grand each way back when 10 years ago. So she made some nice money on these. She had borrowed on them at times. Flip to the next slide. Here's what we suggested she do. Our proposal to her was, let's sell both properties over time. We'll do one first, then do the other one if you feel comfortable. It's going to net you about $240,000 cash. We'll do a 1031 exchange and you'll buy 6 properties with financing that are much more affordable. And our proposal said, hey, we think you're going to net around $350 per property per month times 6 properties. So that's $2,000 per month versus the $300 per month she's making now. And that doesn't include appreciation. And she took no tax hit up front on the sale of these properties. Here's the crazy thing. That was our proposal. She actually made so much on those. She ended up buying 8 properties and she loved the amount of money she made so much that she's actually picked up 4 more from us since then. She now owns 12 properties and she's like, I can't believe I can buy properties this affordably and they cash flow that much. So it's completely changed her life where she now, her goal now, I think she's 54 and she said her goal now was she wants to be a 100% retired in 6 years because she will have paid all these properties off. Anyway, pretty cool. You know, the way we structure them, the potential to use this powerful tool, the 1031 exchange, it's almost unlimited, but do keep in mind the current government, the president, they are thinking about phasing this out. They haven't said they're going to for sure, but they are saying that. So we tell people, if you're thinking about it, think a little bit harder because now may be the time to do it.
Yeah, agreed. And okay, as I mentioned with our needy children that are in college, this is very near and dear to our hearts. I'm going to go through this real quick, just the concept of cash flowing real estate versus a 529 plan. You know, it's only for 529 is only for educational expenses. It's very difficult to generate any income off that money that's sitting there. And if you don't use it, you're going to lose it. Versus cash flow, we're going to show you here in just a few minutes how you can get to a free and clear place in that 6 to 10 years if you're planning for college. You've got that equity and you've got flexible cash flow for forever on those properties. Okay, and we're gonna be wrapping up with just 2 more little concepts, and I wanted to start with one story here, and so I'll spare you all the details on the front end, but I get a lot of calls from people who are looking to invest, they're looking to mentor and all that kind of stuff. Anyway, I had one gentleman that called me and said he had about 160 grand that he wanted to put to work. And we got to thinking about it and said, okay, hey, what if you took that 160 grand and leveraged it into these properties like we're talking about? So if we are taking those properties that we just talked about, let's just say an $80,000 property, and if you've got 160 grand, how many properties can you buy cash, right? You can buy 2 properties cash. But if you leveraged them on the conservative leverage that Travis was talking about, how many can you buy? You can buy 4 properties. So if you take that 4 properties, right, and you say that I want to get all 4 of those properties working together to burn down the notes on there to get me into a free and clear place, right? I call this the Dave Ramsey method, if you guys are familiar with them. So you take all 4 of your cash flowing properties and you're not living off of that income. You're taking that income and you're being deliberate with a deliberate plan to say, how can I get to a free and clear place? So you take all 4 properties and you plow it into 1 property. How long will it take you to get to a free and clear place with that 1 property? Well, I clicked it a little bit too soon, but it's 24 months. You get to free and clear with 1 property. So what do you have? You got 1 property that's no longer half working, but it's working 100%. And you got 3 properties that are kind of half working, but they're all going into the next property.
What do you mean by half working?
Half working. Well, if you've got, I guess I shouldn't say half, but you've got leverage on them. So you've got to make a mortgage payment on those other 3 properties. So you've got all of your cash flow, like for example, in here, it'd probably be in that $600 to $800 a month range, all coming in on that 1 property. But then you've got maybe $400 a month coming in on those 3, but you're taking all of it and you're lumping it into the next property. So we're going to snowball it. How long is it going to take you to get to a free and clear place with 2 properties? I can tell you it'll only be 19 months. Okay. You take the same concept, 2 properties that are just full, all cash flow. And then you've got your leverage cash flow and your other 2 plowing it in. You now get to a free and clear place with 3 properties in only 15 months. You can see how this is snowballing, right? And then finally, if you apply that, you got 12 months to get to a free and clear place with all 4 properties, okay? All that in less than 6 years. That's assuming you don't take that cash flow and go out and buy big screen TVs and motorcycles and all that kind of stuff. You're deliberate with your plan and saying, how I want to get to a free and clear place. Contrast that with that 1 property, or maybe in this case, you might be able to get 2 properties if you can qualify for them with that $100 a month or $83 a month in cash flow. So you've created here in less than 6 years, about $40,000 in annual net cash flow. That's a short time frame, guys. Absorb that for a second. Then take a look at it in what, if you add a little bit of appreciation in there, what have we created? We took that 160 grand and now we have $405,000 in home value. And we've created that about 40 grand in annual net income. Now that doesn't take into consideration an escalation in rent, which we know is likely going to happen over those 6 years. But you could double it, 8 houses, you're looking at 80 grand a year, right? And we have a lot of clients that are doing that with 1031s. Say you extrapolate that out into 10 years. You've got $475,000 in home value, and you've created a cumulative net cash flow of 300 grand with just 4 houses. Likely, you're going to leverage that up because if it works well, take that out 20 years, you got 700,000 in home value. We've got 3% rent increase and 4% appreciation in there. And you've created 800 grand in cash flow over those years with just 4 houses, guys. That is how you get to a free and clear financial freedom place. So anyway, I'm gonna finish up with this. Here we got a little video to watch, but just so we always recap this because people always get confused that these are turnkey properties. You are not fixing them up. I know this is a real estate investment club, but these are properties that are already fixed up and they're performing. We do that. We rehab them. We put the tenant in there. We set up the property management in a place where for our clients, they collect a check. Now, this is how we work with our clients. Again, the concepts we hope that you can take on your own. But what I want to do here is for you to listen to a little video from, this is one of our clients, and this actually was a couple of years ago. He had a plan. He's a contractor guy, and I'll just let it speak for himself.
Alrighty, we're here with Daryl Barajas. Daryl has purchased several properties with Invest One properties. Daryl, tell us a little bit about your experience.
My experience has been great. I was a first-time out-of-state investor. Got with Travis to buy my first properties. Experience was great, and did everything they said they were going to do, and even went beyond even after my purchases were completed.
Okay, and how many properties have you purchased so far with Invest One?
I'm about to close on my 10th property here at the end of the month, so everything's been going great that way.
Okay, and you purchased 10, what, over the last year or so?
Yes, it's been a little less than a year that I purchased the 10, and didn't know I can really do that, but it worked out really well.
Okay, and I know we sat down and kind of built a personal profile with you. What were your goals coming into this? What were you thinking when you first started working with us?
Well, my goals were to, I wanted to get myself set up for retirement, and had a certain number of properties in mind, and figured over the next 5 years or so I would get to where I have so I can retire. And my goals for this year was to have 10 properties. Didn't know if I can reach it or not, but it managed to happen, and Travis and them actually helped it happen with the way that they do everything.
Okay, great. And any issues that you've had, things that you would say, recommendations you would say to other people?
No, I would just say that you would be, it's very nerve-wracking when you're buying your first ones out of state if you never have done that before. But Travis makes it really comfortable going through that whole process. So I would say that's about the only thing that I had a real issue about, was just the nervousness of myself and really having to put myself out there and out of my comfort zone.
Okay, and so you're from Denver. How would you say it's gone so far investing in properties out of state? Have you felt comfortable with it?
Oh yeah, it's been great. I actually love it because I love Kansas City. I love being able to go out there, and it's a lot of fun out there, and it's great going to see my properties. It's a lot of fun doing that.
All right, great. Well, thank you so much, Daryl. Appreciate it.
Yep.
Okay, so Daryl is, as you could tell, he was a little bit nervous on that, but he's a very typical client, and he's been able to leverage up on those properties, and he's been able to get to his goal, and you know, the goal is definitely achievable when you're looking at those smaller numbers. I'm not going to go through all this. This is another testimonial of somebody. If you are concerned about you know, out of your market, you should be. You really should be, because you want to really make sure that you know who you're working with and their experience. And we'd be happy to chat with you guys if you are interested. We'd love to chat with you about our program and how we work with investors. We can work with you just as easily as we can work with somebody here in Colorado. I'd be happy to send out on the chat my contact information and Travis's, or you can take a screenshot of that. But with that being said, let's open it up for some questions. And Rich, I apologize, but I cannot see the chat. It shows up and then it just kind of disappears on me. Yeah. But
probably easier if you guys just maybe, well, it'll probably come back if you kill your screen share, but I know you probably want to leave your information up. So,
but if you want to go through some questions, or if anybody has a question, if they want to unmute themselves, we'd be happy to answer them for you.
Looks like Mimi does, so Mimi, go ahead.
Yeah, go ahead.
Hi, so much for your presentation. And I'm actually closing on my second out-of-state property with similar numbers next week. I'm going through traditional financing because I got it barely over the 50 grand mark. But I was wondering, for your in-house financing, what is the interest rate and term?
Sure, fair enough. Our terms, what we do is we set it up, because what we want you to do is we want you to get into a free and clear place. And we want to work with investors. We always say, I don't want you to just buy one property. I want you to buy multiple properties, not necessarily because I want to sell them to you, but because you're invested now and you're vested in that market. So not that you want to do them all at once, but we want you to have a plan. And so we want you to get into that free and clear place. So generally speaking, our terms are interest only, and there's a 5-year call on those, and right in that 7.9%, or right, Travis, isn't that about right?
Yeah, 7.99. And typically what happens, let's say, Mimi, you decide to buy 3 or 4 properties. What a lot of people do is they'll use our financing to buy the properties because we don't have a prepayment penalty and we only charge a flat $595 fee. So we have a lot of people that will buy 3 or 4 properties from us, use our financing because it's quick and it's easy. And then they'll turn around and do a refinance with like a local lender, kind of as a commercial loan or a blanket loan. That way they can maybe pull some of their cash out and refinance those into a 30-year fixed or a 20-year fixed, or kind of whatever you want to, if you want to stretch that out a little bit. Probably about half of our clients do that. And then the others just do buy and holds and try to pay them off as fast as they can in the 5 or 6 year period.
Yeah,
I'm sorry.
We want them to do that. So go ahead.
I'm a high leverage girl. I do not ever want a free and clear property. And so I'd be looking for a blanket loan. Do you have relationships with those local banks in those areas?
We do. And it's kind of funny, just real quick. We do, and we could certainly get that information to you, that's for sure. But it is kind of interesting because what we learned about 2 or 3 years ago, I should say I learned this. We have 2 different types of clients. Typically, folks are a little bit younger like you and say, hey, Travis, forget about this, paying this off in 5 to 6 years. I got to hit my number of properties before I miss out. So I've got FOMO and I got to have 22 properties or 32 or whatever your number is. And then you're like, once we hit those, then I'll start to think about if it makes sense to pay those off. But then on the other side of the spectrum, we have a lot of folks, let's say they're 55 and they say, hey, we want to retire in 5 or 6 years. We want these paid off. So we've got $3,000, $4,000 a month coming in, help supplement our Social Security so we can use that for retirement. So what you're saying makes sense. And especially for folks that are younger, when I say younger, I don't mean super young, but under 55 or 50. Which you obviously are.
Younger than you, Travis.
Yeah, no doubt about that.
So,
okay, thank you.
Yeah. Anybody else? And I can't see the chat. So, Rich, if you've got that.
Well, one point that was interesting, Brad, that Matt made is he said, as an aside, there are plenty of cash flowing properties in the Inland Empire for much less than the $390, even down to $250,000, which I was unaware of that. But that's kind of interesting to know because we always mark ourselves compared to California. So it's nice to know that relatively speaking, there are still some properties that are somewhat affordable that can cash flow. That's kind of neat.
Yeah, thanks, man.
Maybe you guys could touch on this just in general. I guess we haven't done it too much. We only bought one turnkey property out in Indianapolis, and I wasn't really too involved with it, so I don't know how well it went. Evan looks like he's on the phone right now. Otherwise, I'd ask him. But I have heard just in general, like there's some kind of fly by night, or like, I'm sure you guys are aware of, people that sell, ready to go properties have some negative connotation to them. Like what separates you guys from those people, and why should people trust you?
That's a really good question. And we do see those people a lot. So a couple of things that we do. For one, we've been doing it for 13 years. We've done well over 1,000 transactions. We probably 50% of our business is referral business, but we also want to stand behind our product. So what we do is we do a rent guarantee on every property. We also do a rehab guarantee warranty on all the rehab work we do on every single property as well. Our goal is if we're going to deliver you a rent-ready turnkey property, it ought to be rent-ready. It ought to be cash flowing from day one, and you should not be writing out a check for any deferred maintenance for the first several years, except for normal tenant wear and tear. But in that case, usually there's that deposit in place to help offset that. So we're pretty particular about that. We feel like we've created a system over the years where we've eliminated a lot of the weaknesses where you should be making money from day one. It's just pretty simple, but we stand behind our product. We've been doing it forever. We lend our own money in-house. So we've got a pretty huge commitment. We're not just passing it off.
That's cool. That's really cool. Cause I know with the one we did in Indianapolis, I think within like 8 months, we'd spent probably like almost 10 grand. There was one unit that needed a new shower that was leaking and had mold growing. And we're like, what the hell? I thought, this
it's either turnkey rent ready or it's not, right? It's like, yeah.
And Rich, something that you can appreciate is I run a group very similar to this, which I have for 20 years, and that's where most of our clients come. If things weren't going well, you and I both know that people can get pretty vocal, right?
Mm-hmm.
And so that means an awful lot to us. And as Travis mentioned, most of our business comes from referrals. This is actually first time that we've done a presentation like this outside of our immediate market. So because you guys don't know us, if there's anybody that wants to, talk to our clients, we've got some people that hey, they'll tell you the positives and the negatives. And there's anybody that tells you that you're not going to have some problems at some point in the future is lying to you, because you will. This is an investing business, right? So anyway, but we stand behind our clients and our products. So
awesome. So it answers.
I'm curious as to. I have a question though. I'm curious as to why you don't keep the properties yourselves, or are you making enough money on the financing and the rehab costs, or how do you guys make your money? Why do you choose this business model?
I'll take that, and Travis, I'll let you jump on it as well. The answer is what we didn't have time to talk about here is created a company where people can actually go in and buy a slice of a property instead of the whole property. So in that way, we are holding on to some of them. The other thing is, any way you slice it, it's a capital intensive business. And so we don't keep that many of them there, because this is part of our income business, the way we do it here. Okay. We each have our own portfolios, and we've been doing this for a long time, but this is a segment of our business as well. So anything to add to that, Travis?
Yeah, we only have a finite amount of capital, so we can only hold so many for one. But to be very clear on how we do make money, the way we make money is basically, obviously, we're buying value add properties as affordably as we can, whether we're buying those from banks or however we're getting those. And then we go ahead and rehab those, mark them up, and then sell them. We still try to sell those below retail, but we do mark those up and we make that spread there. That's how we make our money. Plus, we also make some interest, although like we were saying earlier, a fair number of people will refinance us out, and then we're just turning our money. So that's kind of our business model for this side of it.
Yeah.
Okay, thanks.
Mm-hmm.
I was curious. I should ask you guys to do this before. Maybe if any chance you guys have a deal that you're offering now that maybe we can go through and see what the real numbers look like?
I don't have
anything.
I mean, the answer is, well, Travis, I'm not sure that we've got, because all of them are spoken for. I mean, we just contracted on,
or maybe one you just sold, just so we're curious, like what the numbers look like.
Here's what let me give you a typical one. And in fact, we just put 3 under contract today. Typical prices right now. So we try to model it the best we can with those slides, but I would say right now, our typical price on a property, you're going to be looking at somewhere around 85 and 100,000. And we typically, they're all generally above the 1% rule. So let's say you're paying 85 grand. Typically that's going to be probably $900 to $1,000 a month rent. If you're paying 100 grand, it's probably going to be somewhere around $1,100 rent. So we're still able to stay above that 1% rule, which we're pretty excited about. Although it keeps inching up. I mean, the cost of us to acquire properties has gone up probably, I'm going to say 30% in the last 9 months to 12 months, because people have started to discover some of these Midwest markets. But having said that, we're seeing returns very consistently at that 10% mark, just on your cash from the monthly cash flows. Appreciation wise, again, like Brad said, we go very conservative. We're seeing strong appreciation anywhere between 10 and 20% easily. But we tell everybody this: plan on making somewhere around 8 to 10% off your net monthly cash flows, maybe another 5% appreciation, and maybe you save a little bit for tax purposes. Our goal is for everybody to earn somewhere between 15 to 20% between all three of those every year that you hold the property, because I'd rather under promise and over deliver rather than we're promising pie in the sky. And we have seen those margins compress. I mean, back in 2010, I would say that we were getting cash on cash returns of 18, 19, 20%. I'm sure you saw the same thing in California. And now they've compressed down to where it's probably around 10.
I mean, it's a trade-off because we're seeing some good appreciation. Remember, we're not building our investing model off of appreciation, but it sure happens, you know, and things do shift. So when we see appreciation, rents are going up, but also prices are too. So, you know, when we take into account all of those different things, like Travis was talking about, those pillars of real estate investing, you know, it balances out over time, and you will be just fine if you've got a good balance there.
Here's another thing I would say on that to keep in mind, because I think for all of us, we lose sight of this a little bit, because if you're in California or Colorado, we've been getting 10, 12, 15% appreciation for what, 5, 6, 7, 8 years now in a row. So it's kind of normal. We have not seen that until probably the last 18 months in these Midwestern markets. So I feel like we're just at the beginning of the runway here, where we've got a long runway. What's happening is a lot of people are like, hey, why would I rent this property for $900 a month when I can buy it for 120 grand? I can have a mortgage payment, you know, put down 3.5%, 4%, have a mortgage payment of $750 a month, including taxes and insurance, and I can own the property. That's starting to happen. It's pushing up rents. It's pushing up prices for these homes. So we expect to see really strong appreciation for the next 3 or 4 or 5 years. So I think it's a really good time still to get in, where you're going to see some nice run-ups in that maybe we're past that in Denver, is my guess. That strong of appreciation anyway. I'm not sure about the Inland Empire based on what you guys are saying.
And I do want to jump onto that just a little bit too. Remember, we've been doing this for a long time, and it's not just that appreciation happens. We really do take seriously all of those factors that we were telling you earlier in the presentation about those metrics of where we're going to invest. And that doesn't just mean city by city, but it also means neighborhood by neighborhood.
Absolutely.
There are certain neighborhoods that we just don't go in because we know they're not going to be turning anytime soon. But we've been doing this long enough to know what to look for in that specific neighborhood. I can't tell you how many, Rich, you mentioned it, you know, there's a lot of turnkey providers out there that they'll just find a deal and throw you in it. You don't know the market, neither do they. But we do. I can tell you, we spend a lot of time analyzing those micro markets as well as the overall city market as well. So
cool. Right on.
Okay. Anything else?
That's all I have. Anybody else have any questions, comments? Andy's
hey, thanks for giving us the opportunity, guys. Appreciate it.
Yeah, that was great, Travis and Brad. And I always love hearing from other investors in other regions. And I know Mimi is there beaming. She's so excited. So it was a great presentation, great work. And hopefully it gives some people here some ideas and some opportunities.
Yeah, great. And, you know, we'd love to hear from you. Give us a call. Those are our direct numbers, and we'd love to chat with you. All you got to do is I say, I'm interested. We always tell people, just send us a quick email. That number, Travis, can be texted on. The number there, I cannot be texted on. But send me an email. I'll give you my cell phone. Actually, my cell phone, if you want to write it down, is 720-838-5569. But anyway, I'll be happy to respond to you. Either one of us be happy to sit and chat. Just send us a quick email. Says I'm interested. We'll have a conversation and see if this might work for you, and maybe we'll give you some ideas that you didn't think about before. So.
I'm sorry, I had a question.
Sure.
Hey, go for it, Lily.
Thank you, Travis and Brad, for doing this. It was an interesting presentation. I wanted to know, you said about buying the properties, and do you guys actually go there and look at the house, or you have people that would go and look at the house before you buy, or how do you buy these properties?
Can I answer that, Travis?
Yeah. If you notice in my video here, that's the bed from the hotel room in Kansas City where I'm staying tonight. So typically we're in these markets about every 8 to 10 days. We've got our crews here. We got property managers as well, but we literally walk every single house before we buy them. Probably 3, 4, 5 times. So yeah, we are personally, when I say we, it's Brad or myself, are sourcing every single property ourselves by hand. So we're a heavy touch company. We're going to work with you. You're going to be working with us. That's how we do it. And again, like Brad said, that's because we know the service has to be there if we're going to build this company.
Do we have to come see the house if we're out of state or not necessarily?
We probably have about 10% of the people, they'll fly out once in a while and they'll come see him, but most people don't. We can either do video tours, we can shoot you pictures or whatever. Most people never come and see him. In fact, we sold 32 properties to a gentleman a couple of years back, and he's never still seen none of them. And he's had them for years and years now. So it's whatever you're comfortable with.
Yeah, that being said, if you want to go out and look at the market, we encourage you to do so. We don't want to discourage that. But, you know, we know our clients pretty well. And by the time they're going to move forward, we've had multiple conversations with them. And it's not like, you know, we're a low sales company. We don't push anything. We'll give you the information, let you make the decision.
The other question that I had was about, you mentioned Dave Ramsey and the full payoff in 6 months and the 19 months. And I'm sure it's very complicated and I need to study it. But is that after, when the 30-year loan comes in, you were talking about? Because your loans are interest only, I heard.
That is correct. And I'm glad you asked that question. No, our loans are interest only, but what we do is we teach our folks to self-amortize them. Because what we want you to do is in that example, that all of that cash flow is being amortized on one of our loans. And in 6 years, all 4 of those loans were paid off by taking the cash flow and plowing it back in and burning down those loans. That was not a 30-year loan. You could not do that with a 30-year loan. Well, I shouldn't say that. Maybe you could if you could get a 30-year loan on one of those properties. But in that example, it was a 50% leveraged, interest only, but self-amortized, meaning that you take all that money and you plow it into burning the principal down.
Okay, so it has to be 50% down, and although it's interest only, it's self-amortized, and then they pay you for it, or they just put the money aside?
Well, yeah, they pay the mortgage company. In the case, the mortgage company is us. In that case, yes, they're paying extra every month to burn down that principal.
And we could go in it in a little more detail if you'd like. Also, I'm happy to spend some time on the phone with you and kind of walk you through it detail by detail. It's not particularly complicated, but there are some little tweaks to it. But we're happy to go through that with you if you'd like us to.
Okay, thank you, Travis.
Oh,
thank
sure.
you both.
Absolutely.
Do you keep track of the vacancy rates of the properties you've sold, or how does that work?
Yeah, so here's where we're at right now. It's interesting. That's a great question, actually. I would say up until about 3 years ago, we were probably at 13 to 15% vacancy. Again, the Midwest is behind California and Colorado. Now we're running right now at about 3 to 3.5% in both St. Louis and Kansas City. And usually what's happening is our property managers are calling us every day saying, what have you got coming? What do you got coming? When's it going to be rehabbed? We've got good quality tenants waiting for properties. So right now we're not having an issue. Again, as you know, everything's a little bit cyclical. We don't expect to have that issue for the next 4 or 5 years. And our quality of tenants is has skyrocketed over the last 3 or 4 years. There's a lot more tenants than there are properties, and the quality is very strong. A lot of people moving into Kansas City and St. Louis. But having said that, yeah, about 3.5% right now. That's our vacancy rate.
Okay. And that's not multifamily, but that's the single family properties here.
That's single family. Multifamily, I'll be honest with you, we don't have enough of those that I've ever spent any time analyzing what that is. I mean, we probably sell 7 or 8 multifamily properties a year, and I've never broken that out, just being honest with you.
Okay.
All right. Anybody else? Travis, Brad, I think you guys are the first duo we've had in a long time.
All right.
That was cool. That was cool. Thank you very much. Very informative. Like I told you guys earlier, we moved to the lounge session at 8:30, which is pretty much, if you used to come to our events at the Mission Inn, there was the presidential lounge. It was like a bar that everybody kind of moved into after the lounge or after the meeting and kind of hung out. So we try to keep it going on Zoom here. So you guys are more than welcome to stick around. That's pretty much it. Thank you for coming. I appreciate it. Everybody give you a round of applause. You can't really hear it, but
Thank you. Thank everybody. I'm probably not going to stick around. I'm 2 hours ahead of you guys. So I'm going to have to get some stuff wrapped up. And then I got a lot of properties to look at tomorrow because I got to be sourcing properties. That's for sure. But thank you guys so much. Reach out to us anytime. Love to chat with you.
Yeah.
Thanks again, Rich.
And Rich, thanks a lot for the opportunity. And tell Andy to plug his cell phone in earlier so he can stay with us longer next time. So
I got back. I just had to. It ran out. I missed like half of your presentation.
All right.
So
good. All right.
I got back to my place.
Yeah. Well, thanks, Andy. I appreciate you connecting us, and this has been fun. Hopefully, you guys learned something. Again, we're available if you guys would like to chat. So,
right on.
Excellent. Glad you guys could join us. It's a good presentation.
Thanks. Appreciate it.
Travis, reach out to me sometime. We'll talk about Southern California and why Andy and others do well in it.
Yeah, that'd be great. Yeah.
There's some unique things that pretty much nobody outside of California actually knows about here. So
don't tell them. No, I'm just kidding.
Well, I pondered actually not saying anything, Rich. There's several things I don't talk to outside people because I'm like, no, this is like they should hate on California because they shouldn't know about some of the special things here. So,
hey, I love it.
The more the merrier.
So, kind of like Colorado. So, okay.
The more houses everybody buys, the more it goes up in value. We just pump it up. So
there is no shortage of deals.
No, there's not.
You just have to structure them.
And great tax structuring here.
That's right.
Yep.
Absolutely. Okay. I'm going to mute myself. Thank you, guys. I'm going to leave that up until you take it down, Rich.
We're going to take it down pretty quick because it's time to get the lounge session going, which is Brady Bunch view.
All right.
All right. Thanks,
all right,
everybody.
guys. Have a good night. Thank you.
Travis. Thanks, Brad.